Hello dear children. Now in this video we will discuss about the government budget. Okay, so what is government budget? Simply, we can define government budget to be the financial report which states the expected or the estimated incomes and the expenditures of the government. Okay, and it should be remembered that the budget is only prepared for a particular financial year. Okay, and you know that the financial year in India, it starts from 1st of April and it ends on 31st March. Okay, uh, you can message in the WhatsApp group that we have about the financial year of China. Okay, just Google it out. Okay, and what is the financial year of China? Please let me know in WhatsApp group. Okay, so that is your government budget. Okay, the government will decide or look after the sources from where the income can be generated, okay, and the areas where the money can be spent. Okay, so it's all about the income and the expenditure of the government. Okay, so that is your government budget. Now, what are the types of government budget? The types of budgets are: number one, union budget; number two, state budget; number three, plan budget; number four, performance budget; number five, supplementary budget; number six, zero-based budget. Okay, so these are the types of budgets. But we will focus more in these two, that is union budget and state budget. Okay, just go through this: plan budget, performance, supplementary, zero-based. Okay, however, you must go through the chapter. You must read the book. Okay, once, because it's needed. It's very much important that you should go through the book. Okay, and if there is any kind of area where you are having a problem, you know what to do. You can ask me. Okay, so union budget. Now, what is union budget? When the budget is prepared by the central government of any country, that is called the union budget. And in India, uh, it is uh, uh, prepared and proposed in the month of February. Okay, so union budget. So let's have a look at the union budget. Okay, so in this particular picture, you can see that these are the sources of income for the government. Okay, that is your income tax, union excise duties, okay, corporate tax. I hope you remember about this corporation tax, or simply corporate tax, when we did the numericals of national income, right? Then we have indirect tax, that is your GST, okay, custom, okay, excise, custom. So they fall on they are like together sometimes. Okay, and this non-tax revenue also. So in non-tax revenue, some kind of services will be there. Okay, some kind of interest, okay, or profit, dividends, etc. are there. Okay, and borrowings are also regarded as the source from where the money can be generated. Okay, however, it is a liability for the government, but you can use the concept of cash flow statement. Okay, where there is the outflow and inflow. Okay, I hope you already know that part. I don't need to mention about it. Okay, so this rupee comes from, that is your inflow. Okay, that is the incomes, that is the sources from where the money can be generated. Okay, and the expenditures are the areas where the money can be spent. Okay, so rupee goes to, so the rupee, I mean the money, it goes to pensions, okay, other kind of expenditures, this central sector schemes, that is your social security schemes, okay, like PF, okay, ESS, okay. Then we have this e-shram, okay. Then this finance commission and other transfers. Then we have state share of taxes and duties, etc. Because even the government, they have to, when they collect, okay, when the central government, it collects the taxes, okay, all over our country, okay, India, from all the states of India, when the tax is collected, so some portion should be given to the states as well, because states also, they have their portion, okay, they have their share, so they must give it. and interest payments. So if the government has borrowed the money, as we can see out here, borrowings and other liabilities. So if the government has borrowed money from other country, or maybe this IMF or World Bank, so on that particular loan, the interest must be paid. Okay. And then we have this subsidies, etc., and some kind of a government this thing, scholarships also are there. Okay, so many programs are there. Okay, Nirmal Ujjwal, yeah, I don't know exactly, I forgot. In fact, this Manrega, okay, and you must have in your house or your maybe your neighbor as a government employee. So who pays the government employees? Government. Okay, who are in the this IPS, okay, IAS, IFS or IRS services. Government, they pay the money to them, I mean salary to them. So the money will go in those areas. Okay, so that is all about your union budget. So who prepares the union budget? Central government. Okay, now what about the state budget? As the name it suggests, that the state budget is the budget prepared by states. Okay, it's like West Bengal, Bihar, Jharkhand, Rajasthan, UP, MP, Gujarat, Maharashtra. Okay, so let's have a look at this chart where you can see the budget of the state. Okay, so our West Bengal is not in this table. Bihar, Chhattisgarh, Jharkhand, Karnataka, and you know this data is from this one, which is lightly colored out here, light blue, you can say. This is for 14-15, and the darker one is for 15-16. So you can see out here, this is the social sector and the general sector from where the money is collected. Okay, and this is your expenditure portion. Okay, so it is for the state budget. Okay, so we will only focus on these two, union budget and state budget. Okay, remember that union budget is prepared by the central government, whereas state budget is prepared by the state government. Okay, now what are the components or the structure of the government budget? The government budget, it comprises of two parts. Number one, revenue budget. Number two, capital budget. Okay, and again this revenue budget can be it has two aspects. Okay, they consist of two parts. Number one, revenue receipts and revenue expenditures. Okay, revenue receipts and revenue expenditures. Okay, and similarly this capital budget are your capital receipts and capital expenditures. I think this concept is known from class 11 only. Okay, I have been frequently saying to you that the subjects are related to each other. So the concept, this concept is from the chapter called this capital and revenue receipts and expenditures, or revenue receipts or something like that. It's there in class 11. I don't know the exact name of the chapter, but out there you can see the revenue expenditures, revenue receipts or revenue income. Okay, and then we have capital expenditure and capital income. So the same concept has been utilized out here. That is revenue receipts, revenue expenditures, revenue. By revenue, we mean recurring in nature. R for revenue, R for recurring. Okay, whereas the capital receipts and the capital expenditure are one-time expenditures. Okay, you know this from the accounting point of view. So the same concept has been applied out here. Anyway, so what is revenue budget? So revenue budget, it shows the revenue receipts of the government. Okay, as well as the revenue expenditures of the government. By revenue receipts, we mean those receipts which are, in case of economics, it is non-remediable, which means they create no liabilities. Okay, and this revenue expenditures are those expenditures which are to be paid monthly, quarterly. Okay, not annually. Okay, this annual part is for the capital part. Okay, but this revenue, as I already said, that revenue receipts and revenue expenditures, they both are recurring in nature, be it daily or monthly, okay, or quarterly, but they should repeat itself again and again within the particular fiscal period. Okay, for example, this revenue receipt, the example of the revenue receipt can be your income tax or GST. Okay, and the revenue expenditures can be the salary payment to the defense force. Okay, salary, I mean payment of the salaries to the government employees. Okay, so that is your revenue expenditure. Now, what are the capital receipts? Now, this capital receipt is actually the receipts where the government will create the liability. For example, if India borrows money from IMF, that is called the capital receipt. Okay, and if the government is uh, selling its shares, that is known as the disinvestment. So if the government is uh, doing disinvestment, so that time also the money will be generated. Okay, so I mean the income will be generated. So that type of income or the receipt is known as capital receipt. Okay, and capital expenditures are those expenditures which actually will reduce the you can say uh, the reduction of the or the decrease in the financial liabilities. For example, India took a loan from IMF, let's say $5 billion. Okay, now it is repaying the loan and paying the interest also. That is known as the capital expenditure. Okay, so by capital receipt, the example can be loan taken from IMF. Okay, and the example of capital expenditure can be interest, I mean the repayment of the loan. Okay, the payment of the interest will fall under this category, that is your revenue expenditure, you know that part. Okay, now what are the revenue receipts? The revenue receipts, I mean the sources. Okay, this the sources of the revenue receipts can be of two types. One is from the tax revenue and the other one is from the non-tax revenue, or you can say the tax items as well as the non-tax items. Okay, the revenue receipts, remember, one is tax items and the other one is non-tax items. Okay, now the revenue receipts for the tax revenue are income tax, that is your personal income tax. Okay, which is applied in India according to the Income Tax Act 1974, but it has been amended many times, you know that, right? So the next one is the corporation tax or simply corporate tax, then the custom duties, okay, excise duties, okay, then service tax, GST, and interest tax. Okay, now the non-tax revenues are interest receipts. Okay, if government has provided loan to any company, let's say uh, Bharti Airtel Limited. Okay, so government of India, it provided loan of say 200 crores to Bharti Airtel Limited. Okay, and when it uh, earns the interest on that loan amount, that is known as the interest receipts. Okay, it's very simple concept. Dividends and profits. If a government has invested in some company and when it gets the dividend regularly and earns profit, so that is your non-tax revenue items. Okay, and then the revenue from service by the government. Okay, if government has provided any kind of services, then out of that service government can generate some level of income, and sometimes the money is provided through grants also. Okay, that is known as the grants in aid. Okay, GIA. uh, just like Afghanistan, okay, a poor country like Afghanistan, uh, it actually functions on donations by the different countries, right? Just like India. And I hope that you know the news that Pakistan is now ready to uh, supply wheat, okay, through their country, because previously this Pakistan was not ready to supply wheat. India wanted to supply to Afghanistan, but Pakistan, it said no, we will not allow Indian vehicles to pass through our border area or through our country. Okay, so now the Pakistan has allowed. But however, this Pakistan will be using their own vehicles. Okay, so that is your grants in it. That is the donations from the different countries given to a particular country, poor country, in fact, just like Nepal, Bhutan, okay, Afghanistan, okay. So these countries, they actually get donation as grants from different countries, okay. Now, what are the capital receipts? Now, the capital receipts are, as you can see out here, recovery of loans and advances. Now, if I give you that example, Government of India provided 200 crores of loan to Bharti Airtel Limited. And now Bharti Limited, when they return the loan amount, that is the recovery of loan, okay, or advances. Market loans, if government had provided loan to the market, be it a share market, okay, let's take the example of share market only. So it had provided the loan to the share market, now it has covered the loan, okay. Or sometimes it can borrow money from market as well, okay. We will see this in open market operations, okay, when we do the banking chapter. It's very simple. In fact, most of the sections has been removed, okay. So this repo rate and reverse repo rate we will see when we do that particular chapter, okay. So if uh, government take loan from market, again, that is known as the market loans. That is the capital receipt for the government. And some there are there are some kind of deposits which are special, like company, let's say Reliance Industries. It wanted to deposit 500 crores with the government, so that is your special deposit. Okay, now small savings sometimes, and then in the this provident funds. Okay, external assistance, like if you get any kind of grants in aid. Okay, that is your external assistance. And this investment proceeds, government of India is willing to sell Air India, life insurance, and many other things government is selling. I hope you must have heard this in news that uh, our PM is selling the country. Okay, selling the items of our country. Okay, so the selling of these things is known as the disinvestment. Okay. Now, the classification and the components of government budget. Okay, so what are the classifications? It's already given nicely in the page number 323 in your book, that is planned expenditure and non-planned expenditure. See, this planned expenditure and non-planned expenditure, it's very simple concept. By planned expenditure, we mean the expenditure which is pre-planned, okay? I mean, which has been already forecasted, okay? Which has been taken into account already. But non-planned expenditures are of the nature of contingency. Okay, they may arise or they may not arise. Okay, but normally in India, this non-planned because of the non-planned expenditure only, we have a deficit in our budget. Okay, we will see what type of budget we have. Okay, this fiscal deficit. I mean the deficit. Sorry, fiscal deficit, primary deficit. Okay, so we will see it afterwards. Okay, so planned expenditure and non-planned expenditure. Okay, planned expenditure is something what has been planned, but non-planned expenditures are those expenditures which were not included while planning. Okay, now this planned expenditure can be of two types. One is called revenue expenditure and the other one is called capital expenditure. Similarly, non-planned expenditures are also classified as revenue expenditure and capital expenditure. Okay, as you can see out here nicely. Now, this under this head, planned expenditure, revenue expenditure, it can be a developmental expenditure, okay, or non-developmental expenditure. Like in the example of the developmental expenditure, it can be the building up of infrastructure, okay, this communication, transportation, okay, technology, okay, banking, hospitals, educations, okay, construction of roads, etc. So that is your developmental expenditure. Now the government will plan that they will uh, construct a road in this particular area and this much of money will be used. Okay, so that is under the planned expenditure. Okay, now non-developmental expenditures, it can be for example, building up of any kind of statue of a great national hero, or like payment of salaries to the workers, I mean the government workers or the government employees. Okay, so that is your non-developmental expenditure. However, the development is there by providing the salary also, but it varies from perspective. Okay, so that is your revenue expenditure part. Now talking about this capital expenditure under the planned expenditure head, we will see this developmental expenditure again. Now if the government is trying to improve um, the network or the communication in our country, then this government can what do you say, government can purchase a better machinery. Okay, for example, India uh, had a deal with Russia regarding the purchase of S-400, isn't it? So that can be included out here in the developmental expenditure. Okay, because this will develop the defense facility of our country. Okay, if the government decided to uh, set up this optical fibers in the different areas of our country where there is poor network. Okay, so that is also your developmental expenditure because it is a one-time expenditure, right? Now the non-developmental expenditure, again the same thing, that is the government can uh, make the payment of loan. Okay, if the government has taken loan from IMF or the World Bank, now if the money is now being given, it will not contribute to the development of a country. So, but the loan will be paid off, that the liability will be paid off. However, it is a capital expenditure, but it do not contribute anything to the development of our country. Okay. Now the non-planned expenditure. Now similarly, the non-planned expenditure is also the same thing, but it is not just planned. So it is also of two types, that is revenue expenditure and capital expenditure. And similarly, this revenue expenditure are also of developmental expenditure and non-developmental expenditure. For example, if there is because of the flood, okay, a dam was broken. Now the dam must be constructed. So that is your non-planned expenditure. Okay, it's very simple. You must go through this once. Okay, just go through this. Feel free to ask. Remember, please communicate with me. If you face any kind of problem, please let me know. Okay, yeah. Now coming back to the this thing. Yes. Now the balanced budget versus the imbalanced budget. Now this imbalance can be of two types. One is surplus and the other one is your deficit. Okay. Now what is the balanced budget now? A balanced budget is when your revenue is equal to your expenditure. By revenue, we mean the income. Okay, so don't get confused with the term that is your revenue. Okay, so in economics, by revenue, we mean the income in simple language. Okay, so the balanced budget, okay, a budget can be called a balanced budget when revenue is equals to the expenditure. Okay, that is your balanced budget. Now in the surplus budget, what happens? As the name it suggests, you are a commerce student, you already know this part. Surplus, the meaning of surplus. Obviously, this in case of surplus, the income will be more than your expenditure, right? So when the revenue is more than expenditure, then the budget is to be called a surplus budget. Now this deficit budget. By this deficit budget, we mean that the revenue is less than the expenditure. Okay, in this particular case, expenditure will be more than the revenue of the government. So that is a balanced budget, surplus budget, and the deficit budget. Okay, now what are the measures of the government deficit? What are the measures of the deficit now? Because if the if the budget is balanced, no problem, no issue. Revenue, whatever the revenue has been generated, the same is being spent. Okay, that is your balanced budget. Now when this budget is in surplus, that is good for us. Okay, because it will go in the treasury of the government. Okay, revenue will be more and expenditure is very less. Okay, so that the government can spare the money for the future purpose. Okay, however, this situation is also not so good, because the revenue can be generated by imposing high uh, amount of tax from the citizens of country, whereas the expenditure can be very less. Okay, now this deficit budget, this deficit, the term only, this deficit, it's very dangerous. It is not so good. I hope you have gone through the chapter that is your this financial market in commerce. Financial market, finance. When the finance is not so much sufficient, what happens? You already know that, right? Finance is a lifeblood of the business. You know this, isn't it? So the same logic can be applied out here. Deficit budget, that the revenue is less. Okay, whatever the revenue was generated, it was not sufficient to meet the current expenditure. Okay, so this will create the liability. This is a very dangerous situation. Okay, so what are the measures of the government to uh, uh, measure the deficit in the country? They are revenue deficit, fiscal deficit, and primary deficit. Okay, so what is revenue deficit? So revenue deficit is when revenue expenditure minus revenue receipts. Okay, it's very simple. Revenue deficit means revenue expenditure minus revenue receipts. You can see in the formula here only. Revenue deficit equals to revenue expenditure minus revenue receipts. Okay, so what does revenue receipt it signify? It signifies that the expenditure is more than the receipts. Expenditure minus receipts. Okay, so the revenue deficit, it will tell you that the government's expenditure is more than the receipts. Okay, spending more than the income. Like we say no in Hindi, it's called amdani athanni kharcha rupaya. Okay, so the same thing it is. Revenue deficit equals revenue expenditure minus revenue receipts. Okay. Now fiscal deficit. Now the fiscal deficit is equals to total budgetary expenditure minus revenue receipts minus capital receipts, excluding the borrowings. Okay, excluding borrowings, whatever the capital receipt has been gained by the government, that is known as the fiscal deficit. Total budgetary expenditure minus revenue receipts minus capital receipts. Okay, so please learn the formula at least. You must learn the formula. Okay. So What does fiscal deficit it signify then? What does it show? Just like revenue deficit, it showed that the government's current expenditure is more than the receipt. So what does fiscal deficit it shows? It shows that that there is the excess of total expenditure. We are talking about the total part. Okay, whereas in revenue deficit we only refer to the revenue concept. Okay, capitals are not involved out here, but whereas in this fiscal deficit capital part is also involved. Okay, so fiscal deficit it shows that the government's total expenditure is more than the total income. Okay, remember that part. And you should remember that in capital receipts you must exclude borrowings, because borrowings they create liability. Okay, now primary deficit. So what is primary deficit? Primary deficit it shows the difference between the fiscal deficit and the interest payments. Okay, so it indicates the real position of the government's finances. Okay, what the exact or the current uh, uh, government finance is there. Okay, the availability of the finance with the government, because it excludes the interest payment. Okay, so the primary deficit is equals to fiscal deficit minus interest payments. Okay, let us revise one more time now. This revenue deficit is equals to revenue expenditure minus revenue receipts. Okay, it will show that the government's expenditure is more than the receipts in terms of revenue. Okay, but whereas the fiscal deficit it shows the same thing but in terms of the totality. Okay, fiscal deficit it shows the total the government's total expenditure is more than the total income. Okay, excluding the borrowings, because borrowings they create liability. Okay, and primary deficit it shows the current or the not the exact how anyhow, but it will show you the government's current availability of the finance, which is equals to fiscal deficit minus interest payments. Okay, now let us have a look at the general view of the budget. Okay, out here you can see on top it is mentioned receipts. Okay, receipts out here, and here we have expenditure. Okay, so in receipts we have revenue receipts. So revenue receipts are of two types. Okay, tax revenue and the non-tax revenue. Okay, you know that part. Now the capital receipts can be of recovery of loan or other receipts, or sometimes the government can borrow from IMF or the World Bank. So the total receipt is equals to 1 plus 4. So as you can see out here, if you total all these items together, it will give you the total receipt. Okay, including both revenue as well as the capital receipt. But if you only combine 2 plus 3, okay, this amount, that is your revenue receipt, it will total to 17,29,682. So that is your revenue part. But the capital part is 727,553, right? But if you combine these two, then you will get the total receipt of the government for a particular financial year or a fiscal period. Okay. Now this total expenditure, okay, it includes both capital and revenue part. Okay, so here you can see in your book in this number 10 is mentioned on revenue account, which means it is the revenue expenditure. Okay, this interest payments. Okay, you can see out here this grants in aid for creation of capital assets on capital account. So that is your capital part. Okay, these two, grants or the capital account part. Okay, and the revenue deficit you can see out here. The revenue deficit is expenditure minus income part. Okay, that is your 10. As you can see out here, this is your revenue expenditure, isn't it? This is your revenue expenditure on revenue account. This is your revenue part. On capital account, it is your capital part. Okay, capital expenditure, revenue expenditure. So revenue expenditure minus revenue receipt. If you do so, what happens? You will get a deficit, of course. Okay, because this is your revenue receipt total amount, 17,29,682. So if you subtract this, I mean 17,29,682 from this 21,40,612, you will get the figure of 4,10,930. So this is your revenue deficit. And what is the fiscal deficit now? We already know that the fiscal deficit is equals to total budgetary expenditure, total expenditure. This one, total expenditure. This total expenditure minus revenue receipts. This one, revenue receipts minus capital receipts. Okay, minus capital receipts, excluding the borrowings. So this capital receipt you can see out here, it has three components out here. Number one, recovery of loan, and the other one is other receipts and the borrowings. So this borrowings will be excluded out here. Okay, so this is how you calculate the revenue deficit, fiscal deficit. Okay, and how to calculate the primary deficit now? The primary deficit is equals to fiscal deficit minus interest payment. So this is your fiscal deficit out here, 6,34,398. So here in this, if you subtract this interest payments, 5,87,570, then you will get the figure of this primary deficit. Okay, so this is your general overview of the government budget. Okay, this format is a very simple format. Okay. Now, what are the implications of revenue deficit? I have already in brief mentioned that the revenue deficit, it indicates the government's current financial status. That is, expenditure is more than the income. Okay. And the implications of fiscal deficit, you can see out here that the government's total total expenditure is more than its income, whereas in the capital receipts, it must, the borrowings must be excluded. Remember, okay? And the implication of the this primary deficit, it shows that the government's real position of the finance. Okay, what amount of finance it has got, excluding the interest burden. Okay, so these are the main implications of this revenue deficit, fiscal deficit, and primary deficit. Okay, so please go through this part. I hope you will understand. And this much is there in this chapter, government budget, because few portions have been removed. I have already sent you this. Let me just tell you that 17.2, okay, 17.8 and 17.9, that is including your 17.9.1 17.9.2. so all these portions have been removed for this particular year. Okay, in fact this 17.8 is also removed. Okay, you just have to know the meaning. Okay, for the general level of understanding, just understand the meaning of the revenue deficit, what is fiscal deficit and primary deficit. As a student of economics and commerce, you must know this part at least. Okay, however the implications are not so important. However, please go through once so that you can have the general idea about the government budget. Okay.